The stock market does not destroy most people quickly. It destroys them politely. It lets them feel smart first. It lets them feel early, informed, rational, even superior. Then, years later, after enough small errors have compounded into one large disappointment, they begin looking for some dramatic explanation. They blame the Federal Reserve. They blame a recession. They blame politicians. They blame short sellers. They blame algorithms. They blame Wall Street. Very often the market did not ruin them at all. They ruined themselves in completely ordinary ways. That is one of the hardest truths in investing, and one of the most useful. I have spent most of my life around markets, businesses, panics, euphorias, frauds, recoveries, and human beings who kept trying to turn a simple discipline into a form of emotional theater. The longer I stay in the game, the less impressed I become with brilliance, and the more impressed I become with the ability to avoid a few recurring mistakes for a very long time. That is the whole game more often than people want to admit. People think wealth in the market belongs to the person who can predict the most, move the fastest, discover the next big thing earliest, or build the cleverest spreadsheet. I do not think that way. I think wealth often belongs to the person who can remain sane while other people are trying to be extraordinary. If I had to reduce decades of observing investors into one plain observation, it would be this. Most large financial failures begin as very small acts of self-deception. A man tells himself he can time the market. Another tells himself his cost basis matters morally. Another assumes a company can grow faster and longer than the economics of the real world allow. Another borrows because he is impatient. Another gets trapped in detail because detail gives him the feeling of control. Another refuses the obvious opportunity because he wants a slightly better entry and cannot bear to overpay by a few percent. Every one of those mistakes sounds manageable at the beginning. That is why they are so dangerous. The market does not usually kill with one dramatic blow. It bleeds through behavior. The first mistake I want to talk about is trying to time the market. This error looks intelligent from a distance. It says, I will buy the dips and avoid the peaks. It says, I will keep my powder dry when things are overheated. It says, I will wait for better conditions. It says, I understand the economy, the Federal Reserve, inflation, politics, valuations, and the emotional state of the crowd well enough to sidestep the pain. That sounds prudent until you ask the only question that matters. Can you actually do it with any repeatable reliability? In my experience, almost nobody can. Charlie and I never spent our lives trying to figure out where the stock market itself would be next quarter or next year. Ben Graham, for all his genius, occasionally drifted in that direction, and I think that was one of the less useful parts of his example. I know many people who have done well by selecting superior businesses. I know very few who became meaningfully rich by predicting the market's general movements again and again. That should tell you something. The market's direction is certainly important. It is not sufficiently knowable, and that difference matters. I have always tried to focus on what is both important and knowable. That sounds simple, but the entire market tries to pull you away from it every day. It wants you to care about interest rate decisions you cannot predict, elections you cannot control, geopolitical developments you cannot model, inflation readings you cannot trade consistently, and moods you cannot quantify in time to profit from them. Meanwhile, the knowable work sits quietly in front of you. What kind of business is this? What are its long-term economics? How trustworthy is management? What am I paying relative to what I am getting? That work is less glamorous. It is also more profitable. A great boat can be hit by bad weather. That does not mean the investor's job is to become a meteorologist. It means his job is to own the best boats at sensible prices and let time, on balance, reward the superior craft. The second mistake is becoming emotionally attached to your purchase price. This one is so common that most investors no longer notice it in themselves. A stock falls below what they paid, and they call it unfair. A stock rises above what they paid, and they call it a winner, as though the original purchase price has become part of the company's identity. Neither reaction is intelligent. The stock does not care what you paid. The company does not know. The future does not consult your brokerage statement before unfolding. A person who bought Amazon years ago at a low price and a person who bought it later at a much higher one now own the same business if they still hold it. From today's price forward, both will experience the future returns from today's level, not from the emotional significance of the number printed in their memory. Yet people keep making decisions as if the old price should govern the new reality. They refuse to buy more because the stock is above their cost basis. They refuse to sell because they want to get back to even. They feel genius because they are sitting on a large gain. They feel cursed because they are sitting on a loss. This is autobiography pretending to be analysis. A proper investment decision should begin from a blank slate. If I did not already own this business, would I want to buy it today at this price? That is the only question worth asking. Everything else is mostly emotional residue. I have made mistakes because I anchored on the wrong price too. Walmart is one of the great examples. I recognize the quality of the business, but the stock moved a little beyond the price I originally wanted, and my mind remained attached to the older, lower number. The stock did not care. The business did not care. Reality simply went on without me, and Berkshire lost billions of dollars of wood, be gains because I let a prior price become more. That is how expensive anchoring can be. The third great mistake is underwriting heroic growth. This has become especially popular in eras when capital is easy, and stories are abundant. People look at a stock that seems expensive on current earnings and say yes. But if earnings keep growing like this for 10 years, it will turn out to have been cheap. That sentence has probably justified more foolish purchases than almost any other in the market. I like growth. I admire growth when it is real, durable, and economically valuable. I do not admire paying almost any price for it. Very few large companies can sustain extraordinary growth rates for very long. They run into competition, saturation, capital needs, cultural bloat, regulation, bad acquisitions, and the simple law that growth becomes harder from a large base. Yet during optimistic periods, markets behave as though this reality no longer applies. A company will be priced as though 15 or 20% compounding is almost inevitable. It is not. The world is full of businesses that looked unstoppable right before they became ordinary. I would much rather pay a fair price for durable economics than a heroic price for a dazzling narrative. Growth is wonderful when it arrives. It is dangerous when it has already been over-purchased in the stock. This is one reason Charlie, and I always liked looking at how much capital a business required to grow. A company that can expand without consuming enormous additional capital is very different from one that must constantly reinvest just to maintain the appearance of momentum. Investors often confuse top-line excitement with owner economics. The two are not the same. A high multiple supported by fantasy is still fantasy. A great business can become a bad investment at the wrong price. That is one of the central truths people keep relearning. The fourth mistake is leverage. If there is one force that can turn a good idea into a personal catastrophe faster than almost anything else, it is borrowed money. I have seen bright people ruined this way, not because their analysis was absurd, because their structure was fragile. The public thinks leverage is dangerous only if you are wrong. That is not true. Leverage can destroy you even when you are broadly right. A hedge fund manager can identify a foolishly overpriced stock, short it, and still go broke because the stock rises before it falls, and the margin call arrives before the thesis is vindicated. A real estate investor can own decent property and still lose everything because the debt schedule and refinancing assumptions were too aggressive. A trader can be directionally correct over 18 months and permanently broken in 6 weeks. That is the cruelty of leverage. It introduces a clock and a referee. Without leverage, a temporary decline is painful. With leverage, a temporary decline can become final. Charlie and I never wanted to live at the mercy of a lender's patience. We preferred a structure where the market could be wrong about us for a while without having the power to evict us from our own position. I have always thought it was insane that intelligent people would risk permanent impairment for the sake of speed, but greed makes speed look seductive. People do not leverage because they hate money. They leverage because they want more of it faster. That desire has broken many lives. The market does not owe you quick validation. If your strategy requires quick validation to survive, it is a poor strategy. The fifth mistake is missing the forest for the trees. I have often said that when buying a business, the truly big things are usually the future economics of the business and industry, the quality of management, and the price. If those are right, many other details diminish in importance. That does not mean details do not matter at all. It means they are not where the life of the investment is usually decided. A person can bury himself in supplier contracts, patents, legal footnotes, one-off labor disputes, and endless operational trivia, and still miss the simple fact that he is studying a bad business in a bad industry. Another can know every little detail about a mediocre enterprise and tell you very little about the moat, the capital intensity, or the long-term earning power. This happens because details feel safe. They create an illusion of mastery. The investor thinks that if he knows enough facts, he has reduced uncertainty. Often he has merely distracted himself from the few facts that actually carry the weight. I have spent very short periods deciding on some purchases because the essence was clear. The economics were strong, management made sense, the price was attractive. I did not need a month to understand what mattered. Other times I have spent much longer, but the point is never to prove seriousness through duration. The point is to identify what really counts. People who cannot distinguish the essential from the decorative often mistake labor for progress. That mistake is more common than you think. The sixth mistake is choosing 7-foot bars simply because they look impressive. Most fields in life reward visible difficulty. The person who solves the hardest equation, climbs the most dangerous mountain, or builds the most complicated machine is treated as admirable. Investing is different. The person who chooses the easier problem often does better. Charlie used to say he preferred multiplying by 3 to multiplying by pi if the answer paid the same. I agreed. In investing, the ribbon does not become worth more because the problem was harder. People think if they jump over a 7-foot bar, they will somehow earn a superior return because the act itself was difficult. Not true. A simple, understandable business with good economics at a fair price can make you rich. A complicated, high-theory, elegantly modeled speculation can make you poor. Long-term capital management was filled with people of extraordinary mathematical talent. That did not save them. I have always believed that if you can find 1-foot bars, you should step over them all day long and leave the 7-foot bars to people who need applause more than money. Difficulty has prestige. Simplicity often has profit. These are different currencies. The seventh mistake is shrinking your opportunity set too much. This one hides inside virtue. People think discipline means narrowing their universe until they only look at one country, one sector, one theme, one factor, or one fashionable category. Sometimes that is sold as expertise. Often it is simply self-imposed blindness. Now, staying within your circle of competence is essential. That does not mean making the circle so tiny that almost no opportunities can enter. A fisherman who stays all day in one dead spot because he wants to prove loyalty to his first choice is not disciplined. He is stubborn. The market rewards open-mindedness more than many people realize. Great opportunities appear in strange places because pricing is set by human beings, and human beings often become dogmatic about where value ought to be. If you define your universe too narrowly, you may miss the best ideas precisely because they arrived wearing the wrong industry label or sitting in the wrong geography for your pre-existing preferences. Berkshire never wanted to circumscribe its actions unnecessarily. Size eventually shrinks opportunity on its own. That is reality, but we never wanted philosophy to do the shrinking for us first. It is good to know where you are competent. It is bad to behave as though opportunity owes you the courtesy of arriving only inside your favorite category. The eighth mistake is staying active all the time. This error is almost built into the modern market. Quotes move every second, news arrives constantly. People interpret movement as invitation. If you feel you must invest every day, you can make a lot of mistakes. Investing is one of the very few activities where the rules permit extraordinary patience. In baseball, good pitches pass and eventually you strike out if you do nothing. In investing, there is no called strike for waiting. That is an enormous advantage. Most people waste it. They swing because they are restless. They swing because they are afraid that inactivity makes them look foolish or unproductive. They swing because money sitting still feels morally wrong to them, even if they have no edge in the moment. This is expensive. You should wait until you get the fat pitch. Not because patience sounds wise in the abstract, but because quality matters more than volume. An investor who buys 5 excellent opportunities a year may do better than one who buys 50 mediocre ideas to satisfy the emotional need to stay in motion. I have often thought that the market transfers wealth from the impatient to the patient, but more specifically, from the active without reason to the inactive with reason. The 9th mistake is over-diversification. Diversification is very useful for the person who does not know much about individual businesses or who is unwilling to follow them. For that person, broad diversification through something like an index fund is wisdom. But there is another kind of investor, the know-something investor, the person who actually does understand businesses and can identify a small number of superior opportunities. For that person, too much diversification can become dilution. If you really know businesses and you can identify 6 wonderful ones, you probably do not need 30. Very few people have gotten rich on their 7th best idea instead of putting more capital behind the first one. This does not mean recklessness. It does not mean betting everything on one company because conviction feels exciting. It means every added holding should earn its place. If a new stock is weaker than what you already own, why add it except to create the appearance of safety? Many investors hold long lists of stocks the way nervous people collect backup plans. It feels careful. It often lowers the impact of what you truly understand. A cocktail does not become stronger because you mix stronger liquor with weaker liquor and then call the whole thing more diversified. Often it just gets diluted. The 10th mistake is confirmation bias. This one may be among the most human of all. Once a conclusion enters the mind becomes excellent at defending it. New information gets interpreted in a way that leaves the old conclusion intact. Charlie had a wonderful way of describing this tendency, and he was exactly right about it. Investors buy a stock and then begin reading only the reasons it will work. They become defense attorneys for their own portfolio. Anything negative becomes temporary, misunderstood, or overblown. Anything positive becomes proof they were right all along. This is not rationality. This is attachment wearing the costume of conviction. Charlie and I both made large mistakes because we were unwilling, at least for a time, to look afresh at something. That is very dangerous. The antidote is to build systems that force fresh thought. You should maintain a pipeline of alternate opportunities and compare them honestly with what you already own. You should intentionally seek bearish arguments. You should invite someone you respect to explain why your thesis is weak. And you should ask whether the best reason you have for holding something is truly business quality and valuation, or simply the discomfort of admitting a prior decision may no longer deserve your loyalty. The market does not care about your loyalty. It cares about the economics. The 11th mistake is following the herd. This is one of the most socially tempting mistakes because in ordinary life, the crowd can often be useful. If a great many people admire a film, a restaurant, or a city, the consensus may contain genuine information. In investing, consensus is different because price mediates everything. There is no such thing as a good idea, regardless of price. A magnificent company can become a poor investment if everybody already agrees too enthusiastically and has bid the stock far beyond what the future can justify. A mediocre company can become a good investment if hatred has driven the price low enough. This is why the herd is so dangerous. The herd often arrives after the move has already happened and mistakes visibility for safety. If all your friends love a stock, if your relatives are getting rich in something that appears easy, if the taxi driver agrees with you and the whole room nods, you may be much closer to danger than opportunity. I made one of my more embarrassing mistakes because I let someone else's visible success influence me in an area outside my circle of competence. The allure of easy money made me forget a rule I already knew. If that position eventually works, I will call myself lucky, not wise. The herd is persuasive because it reduces loneliness. Independent investing often feels lonely at the beginning and obvious later. That is exactly why most people never do it well. The 12th and perhaps greatest mistake is omission. The biggest mistakes we have made at Berkshire were not usually the things we did. They were the things we understood and failed to do. That is painful because omission does not leave a scar immediately. A bad purchase hurts you visibly. A missed purchase hurts you invisibly, until many years later when the compounded outcome finally reveals what hesitation cost you. Fannie Mae was one of those. Walmart was another. See's Candy nearly joined the list until Charlie pulled me over the line mentally. There were businesses inside my circle of competence, opportunities I knew well enough, and I hesitated. Sometimes the hesitation came from price anchoring, sometimes from false caution, sometimes from the comfort of waiting just a little longer. This is what makes omission so expensive. It often feels prudent in the moment. No red number appears. No one calls to tell you that your inaction just cost you billions. Life simply goes on while the opportunity compounds without you. Years later, the arithmetic becomes obvious, and by then the lesson is expensive. That is why it is not enough merely to avoid bad actions. You must also be willing to act when the opportunity is plainly within your competence and a person who identifies something wonderful and then nibbles at it like a mouse because he wants an even better entry is not being disciplined. He is often being timid. The market will punish timidity too. When you put all of this together, what do you see? You see that the market does not require a superhuman intellect to beat average behavior. It requires sobriety. Do not time the market. Do not anchor on your old purchase price. Do not believe extreme growth stories casually. Do not use leverage. Do not get lost in minor details. Do not admire complexity for its own sake. Do not let your opportunity set become a prison. Do not stay active just to feel alive. Do not diversify so much that you dilute your insight. Do not become the defense lawyer for your own mistakes. Do not follow the herd, and do not stand frozen when a real opportunity inside your competence is staring you in the face. That is enough. The market is a difficult place for the person who needs constant excitement, constant agreement, constant motion, and constant proof that he is right. It is a much friendlier place for the person who can think clearly, wait calmly, and act decisively when the odds are truly favorable. If I have learned anything worth passing on, it is that large investment success is often less about finding hidden genius than about avoiding familiar stupidity with unusual consistency. That is not glamorous. It is still true. And over a lifetime, truth compounds better than excitement ever will.